What do you want from your money? Today we're going to talk about it on this episode of 50 Shades of Money. Jim, with record numbers of baby boomers going into retirement every day, there have been a lot of studies done on what retirees really want and need to have a successful retirement. I mean, a lot of studies. What we found is the most recent studies show literally that retirees want 7 main things from their money. And if they can get these 7 main things, they feel like they'll be financially successful during retirement. So could you start us off with the number 1 thing that retirees want during retirement?
Well, number 1 is people don't want to run out of money in retirement. That is the biggest concern all of the people that we meet with every single day have about their money. It doesn't really matter if they have $1 million or $20 million. Their lifestyle supports a certain amount of income, and unless they have that income, they're going to either have to downgrade their lifestyle or be in a very, very unpleasant place. And our job at Peak Financial is to make sure they don't run out of money. That is what our skill set is, that is what our background is, and we do this every single day. We've done it thousands of times. We have very sophisticated and modeling that we use to make sure that we can actually predictably design a plan that's going to work for our clients so they will not run out of money in retirement. So Dan, what's the second thing retirees want from their money?
Right now, Jim, with the stock market at record highs, and ultimately every day it seems like we hit a new record high, the one thing that they're worried about is a huge market collapse, and they're really, really worried about a large market loss. So retirees want to protect that nest egg that they saved for 10, 20, 30, 40 years, just like you probably want to protect it. You want to make sure you protect those assets against a 40 or 50% market loss like we had in 2000 to 2002 or 2007 to 2009. We cannot subject the assets to that big of a loss. So if you can protect your assets, which our whole goal at Peak Financial is designing ultra-conservative asset allocations to make sure we can minimize losses from clients' portfolios, and then they don't have to worry and they can sleep at night. What's the third thing, Jim, people want from their money at retirement?
Well, everybody's concerned about taxes, and people don't want to pay too much taxes, and they really don't know what they should do and how do they position their portfolio so they don't get eaten up by taxes. And Dan, because of your background as an enrolled agent of the IRS and accredited tax advisor, you've been able to build very, very complicated but easy for us to use tax software so that we can demonstrate to clients what the taxable income is going to be on a yearly basis, even on a monthly basis. Because some of our clients, when we develop a complete income tax plan and beneficiary plan for them, 2 or 3 years downstream, things change for them. They may want to take a family trip to South Africa on a safari, and it's going to cost them $35,000 or $40,000. Because of the software that we have in-house, we can actually take their plan and tell them within minutes exactly what that tax ramification is going to be. So whether it's on a monthly, quarterly, or yearly basis, or random, we know in advance what those taxes are going to be. We satisfy that big dilemma people have in their minds of, I don't want to get killed with taxes.
Well, like your client last week, Jim, came in and you increased their income from $120,000 a year to $160,000 a year. They were freaked out they were going to pay so much in tax, but instead you were able to calculate they were only going to pay a 14% tax now that they increased their income up to $160,000.
Yeah, and they were actually blown away when they saw that because they were so frightened. How am I going to use my money, and if I increase my money, what's going to happen to me long term? And when they really realized that the tax impact was minimal, they were so happy. So Dan, what is the fourth thing people want to know about their money?
Well, the fourth thing is they really want to make sure they can understand, control, and manage their fees, because they've heard so much right now in the press from Tony Robbins talking about fees, from Yahoo talking about fees. There's so much about fees, you have to make sure you control it. You look at the DOL ruling that now has been postponed a little bit. It's about fees, and most clients have no idea what they're paying in fees. Clients that come into our office, they'll tell us, I'm paying 1% in fees, or they'll say, we think we're paying 1% fees. In both cases, they have no idea what they're really paying in fees. And we find out as we use our software that they're probably paying closer to 3.25%, 3.5% in total fees. Our goal then is to reduce the fees. Our average client, when we put their allocation together, conservative asset allocation model, our average client probably pays around 1% total fees, direct, hidden, everything combined. So you go from 3.25% to 3.5% down to 1%. We've saved them hundreds of thousands of dollars over the course of their retirement. That then becomes beneficial.
So Dan, when you talk about fees, a lot of clients don't really understand this. They see the visible fees, that's the fee that's on their statement that they're paying their advisor, When you talk about invisible fees, explain to us what that really means.
Well, there's two types of invisible fees really that can affect a retiree. The first is one they have to be told about, and that would be like a mutual fund fee. The problem is a mutual fund fee will be deducted from their mutual funds. The problem is it's not reported on the statement because it's deducted before it comes on the statement. And the average mutual fund fee in the United States is 1.23%. Even if they have a no-load fund, doesn't matter what kind of fund they have, the average fee is 1.23%. So if they're paying 1% to their advisor, now they have another 1.23 over here just in mutual fund fees that do not show up on their statement. They've doubled their cost. Then there's a hidden cost, and that's at the mutual fund level. It's called a trading cost. Not when they buy and sell your mutual funds, your advisor does that, but at the mutual fund level, when they buy and sell the stocks and bonds inside the mutual fund, there's trading costs that have to be paid to Wall Street. So at that point, those fees by law do not have to be disclosed to the advisor or to the consumer, so that right now it averages 1.44%. So you add that all together, they're over 3% in direct and indirect hidden types of fees.
And Dan, there's another fee that's really very difficult to understand. It's called a cash drag fee. The industry averages you're losing about 0.8% every year in the form of rate of return inside your portfolio because of a cash drag. And what that means, if you actually own a mutual fund, the average mutual fund keeps a large portion of their assets, 10, 12, 15% at all times in cash, because they have to be able to pay you back if you want to redeem your shares as a shareholder. Well, that cash isn't earning any interest, just like your money's not earning any interest in the bank. Well, when they calculate all these fees you just disclosed, that's on the entire portfolio, and the loss of yield because some of that money's in cash and not really performing for you, you're actually paying fees on the entire portfolio. People really don't understand this. So when we get back, and you made an earlier statement that the average client's paying over 3%, it's not unusual for us to see a client paying 4 or 5% because of all these fees. And again, we're able to calculate this for this client because they don't know where to go, and we know we have systems to be able to do that for every one of our clients.
So Jim, what's number 5?
Can you earn a reasonable rate of return? And that is a really, really difficult question because we've all been taught for the last 30 years to go on these websites, whether it's Vanguard, Fidelity, whether it's some other brokerage firm, you're able to use those calculators. You know, you can enter, well, I'm going to retire in 20 years or 15 years or 30 years, and I think I can get an 8% rate of return. And it spits out all these numbers. Oh, I can retire successfully. Well, that means nothing at all. Because people don't really understand what the actual rate of return has been earned on some of the major indices. In the last book we've written called Don't Bet the Farm, we did a lot of studies on this. If you take the S&P 500 simply, and it's the broadest measurement of 500 of the largest companies in North America, and you look at that index and people think, well, let's earn 10%. Well, it really hasn't. We've taken every 15 years over the last 20 years, and we looked at what was the average rate of return for each one of those 15-year periods. And the average rate of return was less than 3%. So if you went through these calculations 20 years ago or 10 years ago, and you actually think you're going to earn 8, 9, 10, 11% rate of return, when the S&P 500, the largest, broadest index in North America, has only earned less than 3% over every 15-year period after the last 20 years, well, you might be for a rude awakening inside of retirement. So what is the 6th thing retirees want from their money?
Well, Jim, we find as we meet with consumers, we meet with retirees and start building a plan, the first thing they want, of course, is to make sure they don't run out of money. But the second thing they want is to make sure that they don't run out of money, but then they're able to leave a certain amount of money to their beneficiaries. So they always want to make sure they're taken care of first, but they also want to make sure that their beneficiaries, their kids and their grandkids typically, maybe some of their charities, but typically kids and grandkids are taken care of so that it'll make it easier on their lives. So they want to make sure there's something left. And ultimately, the goal is, we all have, is we want to make sure we have as much money to last us for as long as we live, and then we pass away, and there's this lump sum that gets to be passed on as a legacy to the people we love. And that's what we find retirees really want, and it makes them feel comfortable that we'll actually do an analysis. We call it an asset transfer analysis for the beneficiaries to show, based on how much money they have now, how much income they're going to use, what type of reasonable conservative rates of return they possibly could receive on these assets, how much they could potentially leave their beneficiaries at the end. It makes them feel comfortable to know that there is a high probability their beneficiaries will be taken care of. So what do you think the number 7 thing retirees want for their money is, Jim?
Well, they may not realize this, but what they actually need is a written plan. We ask clients every day when they come in, show us your written plan. And they've been with their financial advisor for years upon years, and they pull out their statements. They think that is their written plan. That is their brokerage statements. Those are their statements they're receiving based on their investments. That is not a written plan, Dan. And what we do at our firm is we put together a very comprehensive written plan for every single one of our clients. Besides all the analysis we do, besides all the documentation we put together about the risks they're taking, the rates of returns they will earn in retirement. We also put all that together in a written document. We lay out every single step the client is going to go through for the next 10, 20, 30 years. They have it in writing every single year when they meet us for their major client meeting on an annual basis. We go through and if we need to edit that or revise it because things have changed in their retirement, we do so. And this document usually runs between 10 or 20 pages long. And as all of our clients know that work with our firm, we actually read this document out loud to them at the final meeting so they know precisely and exactly how their retirement plan is going to work. And when done with that, clients are elated. They've never seen anything like this in their entire lifetime, and they're so pleased with the amount of due diligence and time we spent to create this whole planning process, and we end it with the written plan, Dan.
That's awesome. Well, I know that ties everything together about their money, so they finally have everything in a package and allows them to understand their money for the first time, which is one of our goals. And if we can help a retiree focus on getting these 7 things for their money, we know they're going to be successful, and that's what every single client gets from us as we build out a complete plan for them. Now that we've covered the 7 things retirees want from their money, what's most important to you? What do you feel you need to do to achieve financial security and feel comfortable that you're going to have an awesome retirement? Let us know.
If you like this video and want to create your own retirement income plan, we've just created a brand new video that will walk you through this process. All you need to do is click the link below and we'll send that video to you.